This is Super Investors and the Art of Worldly Wisdom. I'm Jesse Felder.
Object to the test!
My guest for this episode is Julian Brigden. Now, Julian is a master of models. In putting together his macro theses, which have presciently called major moves in everything from inflation and the dollar to the most popular manias in the stock market, he carefully studies intermarket relationships and correlations to come up with a framework grounded in real data rather than arcane theories and formulas. This practical and highly refined approach has served him well for the 10 years he's been running MI2 Partners and for years prior to that. In this episode, Julian discusses how he developed this uniquely insightful approach and how he uses it today to inform his own trading and that of his many institutional and retail clients. So without further ado, please enjoy my conversation with Julian Brigden.
Ever wonder why fund managers can't beat the S&P 500? Because they're sheep. And sheep get slaughtered.
Julian Brigden, welcome to the show.
Thank you very much for having me.
You know, I'm really excited to do this. And thank you for making the trip from Vail.
Oh, whole hour.
Yeah.
Wasn't 2 hours.
Well, I offered to make the trip to Vail, but I appreciate you coming here to the mobile podcast studio. The first thing I got to ask you is we're sitting here on a gorgeous summer day in Breckenridge. And, what was it that first brought you to this slice of heaven in the Rocky Mountains?
So, yeah, look, it's a long way from home. I'm a little boy from just outside London. So what happened is 10 years ago we launched the business. We launched it. We were living, my ex-wife and I were living in New York, or just outside. And as the business grew a little bit, we realized that we had flexibility. We had this ability to go and shift and spend time somewhere. Now, we had to work, as you know, Jesse, right? You're plugged into the machines the whole time. But the reality is we could. And we started to come out here a lot. We were already coming out for skiing. And we started to realize we were living out here and working there. And we thought, can't we combine the two? And in that sense, I guess we were ahead of this sort of COVID world. Thank God we got into our real estate when we did. And that's exactly how it happened. That's how we ended up here.
Well, you were a trendsetter. That the trend accelerated during COVID, but yeah, it seems like this work remotely thing is a trend that I guess I started doing it 20 years ago when I moved from LA to Bend, and I guess we're both ahead of the curve in terms of this. But I mean, I can't imagine a better place to want to headquarters your business.
No, it's pretty. It is
so.
A pretty special place.
Yeah.
Having sort of powder day rules where if there's more than 6-inch powder, no one turns up before lunchtime is a pretty class problem to have.
Absolutely. Well, to go back in time a little bit, I'm curious to know, what was it that first got you excited or interested in learning more about markets and macro?
So I sort of fell into it a little bit by accident. So I was at university. I did this bizarre degree course when I spent 2 years in the UK, 2 years in West Germany, as it was known in those days. And I had this summer program which I did in Austria, and I came back and I needed to fund myself because I hung out with all these Americans who spent all this money drinking and boozing and having a good time. So I went to go and try and find a summer job. I couldn't find one because they'd all gone, and I thought, I'll just take a permanent job and jack it in after 6 weeks and go back to university. And I thought, well, maybe I can get a job in the markets because that sounds kind of fun. And I was walking along London Bridge, and I walked into one of those sort of temp agencies that they had, and there was an advertisement for a junior in a trading room. And so I applied. I didn't tell them I was only going to do it for 6 weeks. Got the job. Fell in love with this buzz that was in the trading room, and basically ended up putting my university on hold and worked for a whole year for Salomon. And just fell in love with markets, fell in love with movement, fell in love with the lifestyle and the P&L that those days that you used to get. And then just got into, as I started to get more into it, I switched eventually into sales. And one way that I focused on attracting clients was to write a narrative about the market, a commentary on the market. And I did that for a while, went back, flitted between trading and sales. Eventually moved to this company called Medley Global Advisors. You may have come across it in the old days. And it was a policy consultancy think tank. And so they'd literally go and see Greenspan, and then we'd go and flog it to our clients for an exorbitant fee. If you could only get that now as an independent consultant, I'd be very, very happy. An exorbitant fee. And that's when I really fell in love with that side of the market, having that sort of insight, that policy sort of background. Moved back into the sell side and tried to combine the two, because I had all these really high-powering clients from my Medley days, because you didn't talk to the junior on the trading desk, you talked to the principal of the firm. And so I had those relationships, parried that in, started writing my own commentary, started to play around with, because I didn't have that policy insight, I was like, what do I have? And started playing around with building leading models. And the whole thing with a lot of our models, and you've seen some of them, Jesse, and you do from time to time, I post them on Twitter, is I'm taking a piece of information that exists today. I'm not making a forecast. I'm not saying, oh, I think oil prices are going to 100. Oil prices are 72 or whatever they are. What does that mean? What does that mean for inflation? What does that mean for industrial production? What does that mean for all these things that we care 6 to 9 months out? And that's the way I do it. Oh, excuse me. God.
Yeah, no, sorry. But we got to have the beverages, because
exactly.
I
don't know where
talking, you get hoarse.
This fluff as well in the.
It is, for those who are listening and can't see, we are in the middle of I think it's an aspen or birch forest. Yep. And it's snowing in the summertime. It's like literally these white, you can't go outside without getting covered in all this white stuff. So yeah, the allergies are going berserk.
I apologize if I do that again, ladies and gentlemen.
No problem.
But yeah, so that's how I got into it, and I really loved it.
Well, fast forward to today.
Yep.
And MI2 is celebrating its 10th anniversary. Congratulations.
Woo!
That's an awesome accomplishment. Yeah.
Yep.
Well, I guess, it's clear you have a passion for models and for the writing side of it. I guess my question is, what was it that inspired you to start your own firm in the first place?
So, actually, I got really, really lucky. So I'd been writing this commentary on the market, sitting on the sell side. I got 08 and 09 right from a trading perspective. There was a time, and there's a Q&A coming up on Real Vision on this, where there was a time in 09 where I thought, whoa, I've got this right. And then I thought, oh my God, I might have this so right that I may not be able to benefit the end of this, because I might not have a seat. In fact, none of us might have a seat. This whole thing could collapse. But anyway, we came out of it, and a couple of clients came up to me and said, congratulations, you've done really well. You shouldn't be working for that French bank anymore. You should have your own gig. And here's a check. And I literally got funded for my first year out of the bank. And so I sort of called my ex-wife and I said, I think we're setting up a company. I've got this big check in my hand, literally. And she went, okay. And that was it.
Yeah. You see so many people that want to do something like that, and it's almost, you see the people who succeed at it and starting their own firm or whatever it is, jumping off, and it's almost as if it's meant to be. Like,
right.
It just happens,
It does happen, and I think our approach was always, look, there's some people who do some fantastic economics work, but our approach has always been different. Our approach was always to try and create the process that you have within a macro hedge fund or a family office or a mutual fund, is how do I make money out of this information? Because I can correctly predict that GDP is going here, I can correctly predict that inflation is going there, but how do I make money out of that? And so my thought process was very quickly to bring in people who had skills that built upon mine. So I was kind of doing the core view, the core models, giving us, if you want, a bias. Is growth picking up? Is it slowing down? What's inflation doing? Et cetera, et cetera. And then build a group of people who've literally run money, because I haven't. And that's what we did. And then from there, we were able to say, okay, so the view on inflation is this. Okay, well, if that's the view on inflation, what's the ultimate trade? What should we be looking at? How's the market position? And these are skills that people who've run portfolios have. And then we've got other guys who say, okay, if you think it's buns, this is the level we're watching. And by the way, it's today, and push the trigger now. And so it's very much that sort of process Jesse, that we try and follow. The discipline of the models built with the trading acumen, skill, portfolio management skills that my other colleagues bring.
Yeah, it's something that's totally foreign to me, coming from, bottom up,
right,
micro focus type of opportunities to really think of it in terms of top down,
right,
macro focuses. So I guess my next question would be, I guess, what is the mission of the firm, and who's really the intended audience for the research you put out?
So there are two real products. There's the institutional MI2 product, and that goes to a pretty wide range of institutional clients. So kind of classic macro hedge fund, a lot of equity hedge funds these days, family offices, some mutual funds, and there's a different time frame. So that's why we typically end up talking about a process. I mean, for example, the first piece that we wrote on inflation was in March of last year, on the lows.
Yeah.
We wrote this thing, MI2 Trader, inflation. We highlighted how inflation was cyclical. We highlighted how break-evens had been crushed because they got sold off by the risk parity boys. They were their inflation hedge. So when they had their VAR shock go across the risk parity portfolios, they dumped these things, and we kind of got into that. But it set us up mentally for this process. So you have a time frame where you start to educate people. That carried on all of last year. The first piece we wrote in this year was inflation's the most important variable in 2021. And that helps guys who are much more slow moving. I mean, if you're an institutional big pension fund, you can't go whack like that. Although I am always a bit surprised when I meet those guys, quite how many go, oh, nice call on this. We managed to whack some out. And you're like, did it really move the needle at all on this hundreds of $billion fund? Right. But they do. But it is ultimately, even the guys who are more tactical and active, it's really about making these guys money. Yeah. They have their own process. You don't manage the risk for them because they'll say, oh, I've got an inflation view, I'm going to express it like this. They're smart professionals. So that's the MI2 product. And then we have the Macro Insider product, which we do with Raoul. And a ton of that, don't get us wrong, is about making money for people. And in a way, Jesse, you get paid less for doing more. You really have to, here's the entrance, here's the stop, here's what our target is. You have to manage that risk much more closely, much more than you would do with a professional, because they have different variables. But a lot of that is about education, and it's a lot about, this is how we're thinking about the world. This is what we're watching. These are these variables. This is how you should think about these things. And so those are kind of the two distinct audiences that we have. And then I suppose I've got a third audience, which is kind of the Twitter follower, the sort of social media space.
Yeah, which is really what drew me to your work,
right,
in the models. And I want to get into some of the models and different frameworks that you utilize. But before we do, I'm just really curious in putting together all of this research and whatnot. I guess I'm curious to know, just what does your daily or weekly process look like? Where do you spend most of your time in terms of research and all that stuff?
So I'm constantly going through the models, seeing if anything has fundamentally changed. And I suppose my biggest workload comes probably 3 to 4 times a year, where I write kind of a quarterly outlook. And I'll go through all the models, I'll kind of look at things, I'll try and square the inconsistencies, and there always are them between the models. What's this one telling me? Why is that one going down, that one going up? That sort of thing. And then we set out, if you want, our stall. And that doesn't change very often. I mean, macro doesn't really change that often. I mean, growth is picking up, it's slowing down, we're near a high, we're near a low, etc., etc. And that's kind of what I will spend most of the intense time. Now, I write an awful lot during the year as well, or between those periods, but often that's shaping the direction of which we do. Beyond that, we have daily calls. I have the whole team, and there are 6 of us, professionals. I think we worked it out the other day. We've got like 154 years of collective market experience. We're all old. And we shape our views on these conference calls, and we hash out ideas, we hash out thought processes. And then we have a chat forum where we, hash them out again if something starts to change during the day. And a couple of guys are really tasked with watching positions and possibly risks, or suggested positions and risks, and so on and so forth. So that is how we do it. I spend a lot of time looking through the economic data. To me, that's very important to see how that's trending, see if it's fitting with the overall framework. Do we need to change something? Spending time looking at the policy side, because whether we like it or not, this is not a free market anymore. These are manipulated markets. Doesn't mean that macro isn't important. I think macro is extraordinarily important, but it's different than it used to be. It used to be that policymakers would react, the macro would react to that, and then that would shape markets. Now it's the macro happens, policymakers respond, and it's the policy response that in a way drives the underlying markets, not necessarily the macro anymore. As we've seen, they can be divorced for long periods of time.
Yeah, well, there's a quote of yours that just stuck with me when I was reading your research in preparing for this interview, and that was just kind of a lead-in to one of your reports. And that was, as is typical with our macro work at MI2, the starting point was a model. And that, like I mentioned before, that was really what drew me to wanting to have this discussion was your models. I think they're just they're brilliant. But I would like to know, just where does this focus on models come from? What was it in your experience or past that you really kind of decided that the models can be drive the framework?
So it was really an experience that I had when I was sitting at Credit Agricole. I hired a guy who was an old friend, a client who was chief economist at Ericsson, and Jonas Thulin, a great Swedish guy, and like 7'4", and thin as a rake. And I hired Jonas, and I'd loved Jonas's work, and I really respected his work for a long, long time when he was at Ericsson. And I wanted him to be strategist for Credit Agricole in New York. And he built these macro models, and it really did get me really addicted to these things as leading. And it was, he went on subsequently to go to Nordea and form that group there. So a lot of the stuff you see tweeted from the Nordea guys originally came from Jonas, and he sort of inspired that group, and he inspired me. And it was just, look, you can build these incredibly complicated econometric models, right? These DSGE central bank things. And when you look at them and you read about them, you're like, oh my goodness, they're only as good as the assumptions you make. And I hate that, right? I mean, because you can't make assumptions, right? I can assume that inflation stays here. I can assume that the propensity to consume stays like this. Well, COVID comes along and blows all those things out of the water. So I would rather start, particularly from a market perspective, because we don't care about 2 years out, right? We care about, arguably 1 minute out, but certainly in the macro space, 3 to 6 months typically, right? If it hasn't worked in 3 to 6 months, it generally doesn't work. And so you can pretty much get a pretty decent lead on that with stuff that exists today. I don't need to build some vast, uberly complicated econometrics model. I can take data that exists today. I can take raw material input prices. It will give me a lead on what inflation's doing. I can take consumer confidence. It'll give me a lead on retail sales, right? All of those sorts of things. And so that seemed to me to be the real sweet spot. And what it does for me, Jess, is it really anchors my view. I'm not going to fight the model, right? If I see inflation rising in the model, I'm going to be looking for things to try and take advantage. Is there something mispriced in the market where people, for whatever reason, have got skewed such a hard direction the other way that I can take advantage of that? And that's what the models do. They give you that repetitive process, and they give you that firm kind of underlying macro commitment.
Yeah, and I think, as you mentioned earlier, one of the things that I find that makes your models so valuable is that they aren't based on these complex theories and things. It's literally, like you mentioned earlier, oil did this, so what does that mean? And historically, there are all these relationships, intermarket relationships that sorry, allergies again. It's happening to me this time. it's not hard to understand how other markets should react when you can look at in the past these things are have been highly correlated. And so one of your models, I'd like to dig into some of these models specifically. I think you recently wrote that your inflation model in particular suggests that core CPI could potentially reach low double digits before 2023. This would seemingly blow the transitory narrative out of the water. What are the factors in the inflation model that you use to come up with these types of targets?
So this one is not an original thought. One of my clients they're insanely smart, and they've been doing some work. They've been really keen at following our inflation narrative, and they sort of bought into it early, and now they're sort of building on it themselves. And one of the things that they went back and looked at, and they had a data set that is far superior to ours, is what happens when you get this combination of not only money supply growth or balance sheet growth, but also fiscal spending. And we'd been very, very keen to stress to people that there was a material difference. The minute that, this whole balance sheet expansion stuff, right? You can get asset price inflation, and we've seen it obviously in spades, right? I mean, you've only got to take the PE of the S&P and put it against the Fed's balance sheet to know what they have done to the equity market, right? And there obviously is some flow through to the real economy because of oil prices, and when you inflate those. And we played all this, and and those sort of things that said to us, we're probably approaching some sort of cyclical peak. But when you look out and you look back at time, the big decider was fiscal. And we'd had it in our minds that an analogy that we've been playing for a long, long time, really 4 or 5 years since Trump came in, was this kind of mid-60s transference from the early 60s, a period of incredibly stable, low inflation, halcyon period in post-war economics, great returns in the equity market, great returns in the bond market. And then you got Johnson come in and just pump the economy, right? Vietnam War, the Great Society, fiscal spending, and it really threw things out of kilter. And we sort of been playing with this idea that fiscal is much more powerful. And so then when the Biden, when we had that first round of fiscal spending really under Trump, that was the first wave of the inflation breakout, we thought. COVID came along and complicated that, and now the Biden administration just doubled down on it yet again. And so what intrigued us was the idea that this fiscal could be just much, much more powerful than just simply printing a shed load of money, right, which is what the Fed does. So it's that combination. So one of our clients took that and really ran with the idea. And they went back and they had this amazing data set, and they went back and looked at, I think, 120 years worth of data. And they found 150 incidences stretched across, 20 odd countries, where you got an incident, both a big burst in money supply growth and rising fiscal spending at the time. And the combination was immensely powerful. When you started to put these thresholds in, you've got to see X amount of fiscal spending as a percentage of GDP and Y amount of money supply growth. Their conclusion was that history suggests, going back, as I said, these 120 years, that the odds of at least 5% core CPI in the US is now 90%. The lead is 2 years, okay? But the median forecast of the inflation was 15%.
Wow.
Just that combination, Jesse, of, because up until now we could be dismissive of this. We've had essentially just balance sheet expansion, right? We just have asset inflation. But when you take fiscal, which takes time to filter in, right, and you take that money supply growth, where's it going to go? It's going to go into the real economy, and the risk is that you do it when you look at it. And so the model we built took that into account, took some other stuff into account, also put in some thresholds on the kind of the limits of growth, so kind of an output gap thesis, which is exactly what, we're not alone in this concern, right? Larry Summers has said, he came out with that great quote a few months ago. I think I put it in the piece where he said, this looks like worse than the 60s because we're shoving this much money, this much fiscal, this much money supply into an economy. And I think he assumed that the output gap was 9%. Recent estimates have put it a lot narrower than that. Where does this power hose of pressure go?
Yeah, I want to discuss that because I have thoughts on the fiscal married with monetary too. But my first thing I just want to ask is, it's really cool for me to hear that this client feedback that you have. It seems like there's a lot of this, really good kind of intellectual, simmering that happens between you and your clients, and that's just a huge benefit from doing what you do, right? Just putting your stuff out there and then having intelligent people read it and apply their own framework to it, and that's such. I mean, we do. So as I said, I spend a lot of time doing these sort of quarterly, 3 times a year kind of big picture views, and then we sort of typically pre-COVID would hit the road and go and see people face to face, and in those meetings you get a ton of feedback. JC. I mean, and actually, in a way, COVID was better. It was a bit stressful because I was trying to do, tens of calls, and they all tend to be jammed in the morning. Colorado being 7 hours out of London and 5 out of New York. 2 out of New York. I would be on conference calls for a long time, and everyone was sitting at home, and no one seemed to have a time limit. In an office, it's like, you've got an hour, spit it out. We'll give you 5 minutes after that for Q&A. Bye-bye. When they're all sitting at home, these calls would go on for like an hour and 45 minutes. I mean, one went on so long, I just said to the guy, look, I really need to go to the loo. I'll be back in 2 minutes. If you want to stay, that's fine. I've got time, but I really need to go to the loo now. I'm a 55-year-old male. It doesn't work. It doesn't work anymore. But the feedback is amazing, and you can get a great view on how people are positioned. Sometimes it's really good. You can see opportunities. Sometimes I had one a couple of years ago, and I went, oh my God, they're all the wrong way round. They're all this way round. Oh, and I had to write this very tactful piece afterwards. But we write this piece called, Thoughts on the Road, where we kind of come out afterwards and try and distill these views for people, for the rest, for all the clients in general. But it's that feedback loop is incredibly valuable. Yeah. It's incredibly valuable. And I've seen that since I've been, writing stuff and putting stuff out there. You get a group of people that get to know you and your own process so well that they start applying it in areas where you're not looking, maybe, and bringing ideas to you. And it's just wonderful.
Yeah,
so
absolutely.
That's really, really a tremendous value. And then you're being able to share that with the rest of your readers. Bringing you back to fiscal and monetary policy, you mentioned I think the parallel to the 60s, and I'm curious about this because it did seem to me that with the Trump tax cuts and kind of blowing out the deficit during an economic expansion, wasn't something we'd seen since that period, that earlier period. And then to me, seeing the kind of the problems in repo in 2019 and all kind of pointing to this monetary policy is already, in 2019 was already failing the independence test. That so much debt issuance is underway now that the Fed is not going to be able to utilize quantitative easing in a discretionary way anymore. They're now going to be forced to monetize whatever fiscal does. So that seems like a sea change to me.
I think it comes back, Jesse. I think, and I'm putting together this piece for a client for tomorrow, and it's kind of probably going to be the essence of a new sort of quarterly update, because these clients come to you and say, oh, can you just talk next week? And you're like, oh God. And they don't realize how much work has to get, because when stuff's happened, you're like, actually the world's changed now. I need really to think. So I've sort of been neglecting my daughter for the last 3 days. But the point is yes, I think we have seen a bit of a sea change, and I think it goes back to this fundamental problem. The US economy is so financialized now that ever allowing a correction in the equity market is in itself almost impossible. If you look at the correlation between non-farm payroll, total non-farm payroll, and the NYSE, broad New York Stock Exchange, it's the same chart, right? If you look at it for capex, It's the same chart. And the problem is you've created this scenario where basically CEOs aren't prepared to produce anything, right? We have a whole bunch of companies out there that really don't produce anything. Certainly, last year, we were funding all these never to be P&L, companies, right? And but what they are paid to do, these CEOs, is inflate the asset price, inflate the stock price, right? So the minute the stock price stops rising, for whatever reason, the immediate response is, let me try and cut costs, right? And the two things you cut are employment and you shut capex. So the Fed is in this unenviable situation where, having inflated these asset prices, and I think, as I said, if you go and take S&P PEs and you put them against the Fed balance sheet, you could argue that they've taken the PE from about 12 to 30. So having pushed up asset prices, having pushed up all asset prices, right? Housing, right? This state's on fire now because people are trying to move into a highly limited marketplace. They've created this, they've created this crack at it, and they can't step back. And the minute they step back, they tried to step back, and let's be honest, they tried it in 15, right? They hiked, they stopped expanding the balance sheet. The Chinese devalued as the dollar went ballistic. The equity market corrected a little bit. A whole bunch of stuff went wrong. And then in 16, they all came back in and said, oops, sorry, right, at Davos. And we had that wave of global intervention to reflate global asset prices. They tried it in 18. It took a little bit more this time because we had that fiscal kicker that was really surprising lift. So they had to shrink the balance sheet and raise rates. But where did we end up? Exactly the same bloody place. The minute the equity market corrects, the minute the housing market starts to wobble, they have to back off again. And so the only get out of jail card now is that we somehow transfer some of that power over to fiscal. We've done it to begin with in wave one. I think there are clearly some questions about 2022, a fiscal cliff. I'm very much in the camp, and what I'm hearing from my buddies, my ex-Medley buddies in DC, is we will get something through. Exactly how it gets through is a separate infrastructure bill, some sort of bipartisan thing followed up by something bigger. Is it just a big reconciliation, screw it, we'll get something through thing with tax increases delayed for a couple of years so you do get net stimulus? The Democrats want to win the election, so they can't allow this thing to go cold turkey. And my bet is the problem is we're at this point, Jesse, with these asset prices to such high levels that not only can we not allow these asset prices to drop, even going sideways for the equity market's a problem, as we've seen in the past, but we can't sustain a level of interest rates which is sufficiently high to naturally clear our debt levels, to attract either domestic buyers or to take the risk of the higher inflation, or even foreign buyers, without choking off housing, stocks, and every other cars, every other rate sensitive metric. And so it leaves it to the Fed. And this comes back to something I've written about, and I know I've sent you the piece, called this impossible trinity, right? How do we square or keep these metrics alive? And there are three. There's the dollar, there's the bond market, and really what you're saying there is, what level can we allow rates to rise to without choking off stocks and housing and car sales and every other rate sensitive sector, when those underlying assets are so nosebleedingly expensive that even a 50 basis point jump in mortgage rates caused havoc. And you can see what's happening with intention to buy data coming out of the housing market, and at the same time keep those assets inflated, if not keep them constantly going up. And it's this, I think, that's we will find, maybe not immediately, but this to me is the end game. And to me, there's only one variable that has to get sacrificed, and I think that, to my mind, is the big trade. Does it happen in September, October? We get a classic equity market correction. I don't know. Does it take, like every other tightening cycle, like the 2013 cycle, the 2015 into 18 cycle, 16 into 18, does it take 2 years? I don't think so. Might be wrong, but I don't think so. But the end game to me, I'm afraid, is clear.
Well, it's interesting to me that that you use that term, the end game, because Bill Fleckenstein and Grant have done a great podcast series on this very topic, and Fleck for a long time has suggested that the thing to take the printing press away from the Fed will be the bond market. And right. I know he's kind of maybe revised this view, but it seems to me that they can't afford to let the bond market take away the printing press, and so right. they'll do anything, yield curve control, what have you, to prevent that. And so the dollar really is the only outlet,
correct,
for that, because they have to prop up stock prices and bond prices.
Yes, and it goes back to, once again, we saw this in the late 60s. I mean, it's not, so we had this period where, we had super slow, stable inflation. I mean, anyone who can sit in front of a chart package, pull up CPI during the 60s, and you'll see early 60s, beautiful, flat line, like plus or minus 0.2 either side of like 1.2. Beautiful. Johnson comes along, kicks off the fiscal spending, inflation pumps out, the Fed come along, and they hit it. The equity market goes, the housing market goes, they panic, just in a way like they did in 2018, early 19, right? They give back all that tightening to the market, and they ease into this sort of ongoing fiscal expansion. Now, what was different back then was we had a pegged exchange rate mechanism. We had this thing called Bretton Woods. It was a post-war fixed exchange rate mechanism, and the dollar was the linchpin. And if you go back and read the Fed minutes, they're really interesting, but there are tons of them because they do them every 2 weeks. But basically, they're watching kind of, as the US economy is overheating through the Johnson Great Society spending and the beginning of the Vietnam War spending, they're watching these current account flows suck dollars out of the system, and gold, right? Gold is literally leaving the US. And they're kind of trying to balance the thing, and they talk about the capital flows a lot. And what they really should have done is they should have said, screw you, Johnson, okay? You're overheating the economy. We're an independent central bank, okay? One of our metrics is controlling the value of the dollar in Bretton Woods, and we are raising rates. And we are raising rates a lot, and we're going to choke off this excess growth and inflation, kill it in the bud. And if that means, killing your ability to spend fiscally, or that means sacrificing the equity market, fine. What did they do? Well, Bill Martin, who's the chairman of the Fed, went away and thought about this, and he came out and he reiterated one of the founding cornerstones of the Fed, and that is the Fed is the independent within government, but not independent of government. And so basically what he decided was to accommodate this Fed spending. This federal spending. How did he do it? He actually did QE. And not a lot of people realize that in the late 60s they actually undertook a policy of QE, and they called it money debt financing. And they basically bought bonds and did QE under the surface. And so even though nominal bond yields rose massively, right, they went from 4 to 8 between 65 and like late 69, real yields fell 300 odd basis points because they just suppressed that rise in real yields. So you supported the equity market, you kept government happy. Yes, bond yields rose, but not nearly as much as they should have done. But what was the ultimate end game? Well, it hung around because it wasn't a fixed exchange rate mechanism, but in the end, solving that impossible trinity between bonds, equities, and currencies, they sacrificed the dollar. And when Bretton Woods went, the dollar imploded and dropped 50% over the next few years. And I think as I look out and I look at these spinning plates and how do they keep them all going, that has to be ultimately where we go.
Well, and that's a perfect lead into discussing your models for the dollar, your framework for the dollar. You've suggested that another 45% decline in the dollar is a distinct possibility. Can you describe some of the models that you use, for the dollar, how you approach analyzing it?
Yeah, I mean, when we look at the long-term stuff, I mean, there's lots of we've got two or three different models that we use for that. They basically all encompass somewhat similar components, and that is, look, as the reserve currency, we are obliged to provide reserves to the rest of the world. So how do we do that? And it's that shifting in that demand and supply of those reserves that's very important to determine the value of the dollar. We do it through a number of vehicles: current account deficit, capital account deficit, some elements within the capital account, budget deficit feeds into that too. So when you start playing around with those metrics, and as I said, those are data that you have today, what you find out is they're pretty damn good leading indicators of what typically has happened in the dollar in the past. There can be some basis shifts, as you'd now imagine, over, when you run these things over like 20 or 30 years, but they're pretty consistent. And we've been doing a pretty good job at supplying the world with dollars. I mean, whether it's a current account deficit, the budget deficit, some of the capital flows, right? We're not paying an economic rate to foreigners to buy treasuries, to take that risk, right? Because the dollar's already very high. So if they buy them now, what's the odds that the dollar could fall? Even if they don't believe my scenario, they're not getting paid a ton of interest rate on it, right? Real 10-year yields are now like minus 300 odd basis points, right? So when you look at those metrics and you put them together, they suggest that we could end up in this situation where we end up with this drift and then this big collapse. The other thing is about the dollar is the cycles are remarkably consistent since 72 in both amplitude and time. And so we've got a fun little one, I don't know whether I sent it to you, where we take the dollar cycle and we have the whole dollar cycle, and then we shift forward like a prior sector of the dollar cycle till we catch another cycle. And basically in percentage change and time frame, it's nigh on exactly the same. This thing rises. As it rises, it is disinflationary. It tends to blow things up. There's a level where you tend to get emerging market crises, whether you go back and you look in the 70s or the 90s, right? Whether it's Latin America or in Asia, you get these crises where the dollar rises too much in percentage terms. Then the Fed kind of backs off. They go, oops, terribly sorry. And then they try and sneakily like, okay, everything's calmed down. Now we can tighten again. And they do it. And then they really create havoc. And then that's it, right? And then the dollar drops. And I think we hit that thing in March of last year. We refer to that final dollar up move as kind of the napalm run. So in other words, left to its own devices, if you didn't stop it in its tracks, this explosive dollar move, because remember, the dollar's denominator of pretty much all the assets that we trade. So as it rises in value, those things tend to fall, and those napalm runs tend to happen in risk-off environments. So, the stock market's falling or commodity prices are getting crushed, gold's falling, and the dollar's rising too. So it's just compounding that downward move. If you do not stop it, all you will be left with, just as you would be at the end of a napalm run, is a bunch of smoking holes and charred bodies. And so typically that's when the central bank comes in and goes, stop. Right? They did it in 2009, 2008, really they started 2009 with all the swap lines and so on and so forth. And this time, in March of last year, they were right in there, right away with lines that we'd never seen extended to counterparties that we'd never seen extended before. So I think they're all too cognizant that a rapidly rising dollar is very, very destructive, but it tends to be, that's when they tend to flip. That's tends to be the top of the dollar cycle. I think right here, right now, we got a little bit of, after last week at the FOMC, which surprised everyone, including all the consultants who just specialize on talking to the policymakers. I think some people got it right, but that was a guess. When you actually talk to the policymakers, you had no clue that this flip was coming. Mm-hmm. That creates a little bit of a problem now because you've got this move in short-term interest rates. I think it makes FX difficult to trade here. But as I said, I think there is no way we could end up with a real tightening cycle in this country without bringing down the equity market, bringing down the housing market, and then the Fed and pissing off the Biden administration because you're undermining what they're trying to do. And I think in the end, the Fed will just blink, because Powell, certainly, if we end up with Brainard, these people aren't Volcker.
Right.
They don't have a ramrod, back. They have Jello.
Yeah.
Right. We've seen this. He's a flip-flopper, Powell. So 15 to 20% down on the S&P, they'll be right back again.
Yeah. And that will potentially be the catalyst for
that's what I think.
And that leads me to, in addition to, the macro framework that you use that's heavily reliant on these models, you clearly use price action as the trigger for positioning. And that to me is also critical, right? You can't just say, hey, here's my macro view, put the trade on, right? So how do you, I guess, approach or look at this, pricing as a trigger for putting the trade on?
So it's not necessarily my skill set, but as I said, I've got, of the sort of 6 professionals in the business, 3 of them have run money, and in one case, 2 of them, very, very large amounts of money, as big PMs at big hedge funds. And so, as I said, when we start off with kind of the house view, core view as the bias, let's say, and we're doing one, for example, in Real Vision, we're going to talk about the bond bear market in 2016 later this week. But it was kind of you look for the macro framework. Where do we think things going? Ideally, I really love it when you get policy error, when you can punch the central banks in the face and tell them, I told you so, which is what obviously we just did last week when they finally capitulated on the inflation story. But then you start sort of looking at dynamics that could have pushed the market the wrong way. The bond market is a classic. The bond market is a classic one because, like a lot of markets, but this one particularly, they tend to lean heavily. They have to rely heavily on central bank verbiage, right? So you get these central banks saying, "We'll never raise rates. We'll never raise rates. We'll never raise rates," and we back in the spring said this is then going to end in one or two ways. For example, when they really do mean it, we're never raising rates, and then the long end of the bond market will go, "Ciao, Bella, I'm out of here." Okay. And or, to use a phrase that was directed towards Mark Carney at the Bank of England, they become the unreliable boyfriend. They say, "I love you, I love you." Ooh, look at that. "I don't love you anymore," right? And that's what we just had last week. So you have this macro thing, you can see these pressures building, but none of it matters until the price confirms, right? As I said, I'm not interested in pontificating about macroeconomics unless I can make money out of it. And money is only made by price confirmation. And so my 3 colleagues who are much more experienced at running risk and managing portfolios tend to look at or take the sort of ideas, and they'll start shifting through, okay, if we're bearish on bonds, is it bunds, is it treasuries, is it BTPs, is it gilts, whatever. Is it JGBs, which frequently it is JGBs, as we know, tend to be very important. We'll look at flow. We'll look at positioning. Has something pushed those market, forced bond investors, for example, into some extreme position? Has some central bank thing forced people into the dollar to some extreme there? And are those forces starting to change underneath? And then ultimately, at the end of the day, when you say, look, I think the macro's changing, the market's the wrong way round, and then you go, is there a chart level that I can watch? Because then you can go, you get decent entry level, you get decent risk reward. Not always right straight away. You might have to have a couple of times to have a go, but you get it. Like when it goes, you're in at a decent level, you can run it, you can add to it, and that's when you can make big money out of it.
Well, it's such an important point because I think so many people don't realize or understand that if you have a macro view that you're not necessarily positioned that way right now. That you arrive at a macro view, and then you're looking for the trade opportunity within that, and you're also looking for reasons why you could be wrong too. Right. But so many people think, okay, well, this is your view, you must be long this or short that, and that's not necessarily the case. It also reminds me of some of what you just said too, of Stan Druckenmiller, who said most of the big money he made was trading against central bank mistakes, and I think most of the money he made was in the bond market, too. So but Stan will famously go on TV and express a view, but he's not necessarily positioned that way at the time, and he could be looking to put on a trade at a later time, and and I think people don't necessarily respect that or appreciate that.
No, I think, look, I mean,
they're two separate things.
Yes, exactly. They're very different things. I mean, it's just about mentally getting your head in the game. So once again, I call it the lean. Am I bullish? Am I bearish? From a macro perspective, in other words, from bearish, the economy is not growing, my inflation's coming out. Am I bullish? We're just at the bottom of a cycle, things are turning up. And then you mentally are looking in the right place. I mean, I can't claim to have caught COVID in terms of the news story. We did. Early in February, I was talking to friends in Hong Kong and saying they bought loo paper. Why did they buy loo paper? It's not a gastric thing. And friends going, yeah, but that's what's gone out of the shops at Costco in Hong Kong, right? There is no toilet paper anymore, right? But we were lucky, Jesse, in the sense that we were looking in late 19. Things were slowing down already. We already had housing starting to falter because affordability had dropped to crappy levels. We already had an equity market that was showing signs of vulnerability. We already had signs that the inflation cycle was starting to pick. So we were mentally there, and it was much bigger exogenous risk than I think any of us had imagined. But the point is it wouldn't have taken a lot to knock this thing down already. I wouldn't have seen the size of the decline, but you could have got a nice 20% correction in the equity market in early 2020 already. And that's what I think is really important, to have that kind of view.
Yeah. Well, it's such a good point too, because for several months kind of prior to COVID, it looked like cyclical sectors within the stock market were dramatically underperforming, and that was kind of a warning signal. And so I think, that macro kind of just informs you to be aware of the risks to whatever side of the equation. So it's but in terms of this allowing price to inform your trading, or direct your trading, there were a couple of charts specifically that you shared over the last few months on Twitter that I found fascinating, and they're related to your classic bubble framework, and I'm referring to specifically Tesla and Bitcoin, which, there are going to be probably people listeing to this that
they're going to want to hang me from the trade.
But, so many people have been calling these things bubbles for so long. And, I think that your timing in these was just remarkable. And so talk to me about this, the classic bubble framework and how that helped you kind of look at these things.
Right. First thing I would say, it'd be bloody lovely if you could just pick the classic bubble as it entered the parabolic phase, because I wouldn't be sitting here now. I'd be sitting, on an island somewhere sipping a gin and tonic. But it's much easier when you get into that parabolic move. So the classic, there are the four classic phases of a bubble. There's kind of the stealth phase, undiscovered. There's discovery phase, when the institutional money tends to come in to anything. It tends to double the price. At the end of it, you tend to have a bear trap, where the institutional money goes, oh, I've doubled my money, yours, and they sell just as that kind of retail-y or wider spread story is starting to kick off. And so you get this correction. You tend to hit these various trend lines, which I've shown on the charts that I've done. You then enter the early beginning of the sort of mania period. Typically, you see a sort of 35 to 45 degree kind of line of ascent. It goes through the previous highs, and then you enter the real parabolic move. Now, typically the parabolic move, if you go back and you look at, tends to have to be created with cash, right? So there's the only bubble that I've never quite understood is the tulip bubble, because I can't see how that was a great story, right? I mean, whether you go back and look at the railway bubbles of the late 1800s, they were great stories, right? Or you know, for example, those, it's a bit of macabre fact of life, though, that if it hadn't been for all the investor money that got put into like the Argentinian railways and the Brazilian railways by British investors in the late 1800s, we wouldn't have been able to kill millions of men in the First World War, because prior to that, we used to send them home in the winter because we couldn't feed them. Courtesy of what was referred to as bully beef, which was tinned Argentinian beef, we could feed them and slaughter, you know, all 12 months of the year, which is clearly, obviously, a very handy outcome. But it's truly a transformative event if you look at it from a societal perspective. Yeah. But the point is you need a great story. The better the story, the better it is. You need liquidity, and that, if you look at prior bubbles, say 2013, that was coming from QE or whatever. Gold was, and silver were initially that as well, when you look at early bubbles there. And then you need, ideally, a trend in the currency. If you get a trend in the currency as well, so for example, the Nikkei bubble, that was post-Plaza. So the yen, the dollar was, central banks were intervening to drive down the dollar, and the yen was rising. So money was naturally attracted into Japan, and had this proclivity to kind of pool up in Japanese assets. What do I buy? Oh, there's this thing called Sony. They've just come out with this Walkman with these strange orange headphones. I certainly had one. I don't. You might be a bit. Yeah. You know, Trinitron TVs, right? They were buying the Rockefeller Center. They're going to take over the world. We were learning about them at business school. They were going to take over the world, and you just take this great story, a lot of liquidity, and then you power it with this trend in the currency, and you create what I refer to as a big boy bubble, and then you kind of get this parabolic move. The parabolic move really does look like it's going to be the jet fighter, and I use this analogy all the time. It looks like the F-16, if you've ever seen one, or the Raptor, is going to go to the moon, right? It is going straight up, and then you forget that at some point, using conventional jets, it runs out of oxygen to burn, and at that point, it doesn't just fly off sideways at 35,000 feet. It goes up and then it drops, and that final move, you tend to create some sort of like little neckline where you get this final up break move, and then it just goes dum, 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 stalls out, drops hard, and that's the first clue that you've got a problem. Now, catching that, we caught silver back in 2011, got really lucky, but catching that zenith is really, really high. You can sense that something's not right, but it's very high. You then drop hard. You then bounce. You bounce hard. You should not break that prior high or that neckline. You should fail. That's the bull trap. And at that point, you're done. Unless something new comes out, you are done. And that was Tesla's rally from, I think, was it 475 on that initial sharp drop to 800? When it failed there, you were done. Because you've transferred from greed, which fueled all of that parabolic mania, to fear. And fear trades very, very differently. If you get the bounce, there's a bunch of people who are going to go, thank you, Lord. Right. Okay? All right, it wasn't 1,000. It's 800. I was in at 400. Yours.
Yeah. Well, it seems to me that, there's a great George Soros quote where he talks about bubbles and about, when a bubble's forming, he rushes in to buy, throwing fuel on the fire. And that's what I think a lot of institutions, do. They see retail going after something, and now they're doing it algorithmically. They're watching, where the Reddit flows are going, and we're going to, whether it's Citadel or who knows, goes piling in. But they also, institutional money knows this bubble framework, and they know once it's broken, it's not coming back again. And so,
and I saw some of it. You talk about the Bitcoin thing. I sat cringing, when you heard some of the. Someone like Stanley Druckenmiller is really a straight up guy, and, as are most of these guys. Some of them are a little, I dealt with them in the currency days, in the ERM crisis and stuff, some of these very big hedge funds, and they'd say one thing and do completely the other, or they'd find that they're all positioned one way, and one of them would go, oh, they're all long, right, hit it hard and smack the hell out of, force the stops, and then they'd buy it. They're quite, so when I'd hear some of these guys on TV, they might be pontificating longer term views, but I know how these guys trade. And they're saying, oh, I'm buying Bitcoin. They might buy it for 1,000 points or 2,000 points or 5,000 points, but their risk management is what they live and die by. And they are, guaranteed you, they are out by the time this thing comes down.
Yeah. There is no, just religious zeal for any security in these guys' portfolios, you see among retail investors. And
look, I mean, you raise an interesting point there, because one of the frequent times that stuff is really getting zealous is when I did it a couple of times on Twitter around Bitcoin, where I threw out a negative view, and I would just get this deluge of you non-believer. Right. And it's not that I'm not a believer. My big concern, and I raised this on a Macro Insider piece that we put out, the last one that ran, and I did, and technically it didn't look right, but I've always thought that the death knell for these cryptocurrencies would come when they challenge the man, right? When they challenge the central banks. Mm-hmm. And I thought in Bitcoin, and it still may be the case, that it could come a lot higher in Bitcoin, when the dollar's really under pressure in a couple of years from now, the Fed's scrambling to try and hold the whole thing together. Maybe Bitcoin's 100,000 or 200,000 at that point, and it's challenging the system, and they just go, sorry, you can't own it. They do what they did with gold back in the 30s. What I didn't realize, and I think is at play here, is how determined the Chinese have moved recently to quash Bitcoin domestically, so that it doesn't challenge the digital renminbi. Mm-hmm. And we were at a Blacklist event, which is the sort of high end of the Real Vision thing. I was invited to a couple of months ago in Aspen. And the older people around the table, the ones with grey hair, not necessarily the richest, because those are the ones who'd made more money in Bitcoin than made sense, were much more skeptical of that than, should we say, the younger people who had that religious zeal. And I don't want to beat it out of people. It's whatever you do, whatever you invest in, whether you believe in it, and you should believe in it, please put the risk management tools around it.
Absolutely. I mean, it's such a great point that I think that's the only difference between, and, I've said for a long time, I have huge amount of sympathy for the Bitcoin cause. I think it comes from the right place.
Correct.
And it really gets what's going on in the world monetarily and all this stuff. But I think your point is a valid one. The only thing that, older investors have learned that maybe younger ones haven't is that risk management is what, protects you from.
Yeah. I mean, so last March, the first trade we did off the lows was we bought silver at like 12.16. We ran it up. Then we got out at like 26.5 or something on average. And I got an email on one of the internal chats on the Macro Insiders thing saying, oh my God, thank you very much. I've paid my mortgage off. Right. And the first thing I wrote to this guy was, congratulations, never do that again, because you're running way too much risk.
Right. Well, that's, I think, one of the signs of the current, where we are in the market currently is that, the just perception of risk has been so skewed, you've let me take up so much of your time, Julian. I got, to bring it back full circle. What do you do? You live in this beautiful area. What do you do outside of the markets to stay sane in terms of, getting out? You mentioned skiing, and maybe how does it inform or make you better at what you do, if at all?
So it depends. I mean, as I said, if you ask my daughter over the last 3 weeks, I generally showered at 6 o'clock in the evening because I've been trying to punch this presentation. So I don't always get balance, Jesse. I wish I did. But I do find, whether it's hiking or skiing, hiking's different. It just kills you up at 8,000 feet if you go for a big hike up here. And it really mentally, you just have to focus on one step in front of the other. And I do find that. But skiing, I just can't think of anything else. You're so focused, and I'm really not a very sporty person. I'm not a very body aware person. But when I'm skiing, I'm just so focused on the angle of the ski, where my foot is in the boot, where my hands are, that it's almost like a yoga type experience for me. For a day or whatever, I ski with the ski group that I do, from 9 till sort of 3 in the afternoon. I just don't think about work at all.
Yeah.
And it just helps me clean my head, and is the payoff for times like the last 72 hours where I sat in my pajamas until my daughter gone, "You stink, Daddy."
Well, it's so important. And my father-in-law, years ago, we were, I think, fly fishing together, and it was 20 plus years ago. And he said to me, these types of purist pursuits are so important that, the things that you do, whether it's playing golf or fly fishing or skiing, that require so much of your focus that they don't allow you to think about markets or anything else. That it's a clean.
It's a cleanse.
Yeah,
it literally
absolutely.
it's a mental cleanse.
And it's just crucial. I can't thank you enough for taking the time to do all this. I have to just tell everybody listening that if you don't already follow Julian on Twitter, you need to. You're so generous with your sharing information there. It's just at Julian MI2. Is there anywhere else you'd like to direct people or anything else you'd like to just highlight?
I mean, if anyone is institutional and wants to get in touch with us, that's just reach out to support at mi2partners.com. And then if anyone's interested in the Macro Insider things, they can either ping us there, or they can go to the Macro Insider link in Real Vision. We're bound to have some campaign soon. They always do, and you'll get a good deal. And I think we do make our money, Raoul and I.
Yeah, well, it's been a pleasure to do this. I feel selfishly this has been a wonderful opportunity for me to pick your brain. I know my listeners are just going to get a ton out of this. So thank you so much for taking the time.
Pleasure, Jesse, and you do great work, and I read all your stuff as well. So yeah, it's great to be on the show. Thank you.
And that does it for another episode of Super Investors and the Art of Worldly Wisdom. As always, you can find notes and links related to this episode at thefelderreport.com. Thank you for listening, and until next time, buy low, sell high.
Man looks in the abyss. There's nothing staring back at him. At that moment, man finds his character. And that is what keeps him out of the abyss.